All right, let's jump right into this explainer and investigate a really fascinating financial mystery. We're looking at a fundamentally sound medical tech giant, Intuitive Surgical. Now, if you follow the healthcare sector at all, you definitely know their name. They are an absolute titan in robotic-assisted surgery. But recently, well, their stock chart has looked less like a steady, predictable ascent and a whole lot more like a roller coaster. It's a totally bizarre disconnect. So today, we're going to look under the hood and figure out exactly what happened here.
To set the stage, let's talk about their Q2 2026 earnings report from July 16th. By pretty much every conventional metric, the raw numbers were stellar. I mean, they posted an incredible $2.89 billion in revenue. That's up 18.5% year over year, and it comfortably beat Wall Street's estimate of $2.82 billion. And hey, it wasn't just revenue. They delivered a massive adjusted earnings per share beat of $2.80, completely blowing past consensus estimates that were sitting around $2.50 to $2.55. Honestly, on paper, this is exactly what you want to see from a growth powerhouse.
But here's where the story takes a really sharp turn. Despite absolutely crushing those expectations, the stock suffered a brutal 14% plummet in mid-July. We're talking an almost overnight drop from over $402 a share all the way down to roughly $345. Literally billions of dollars in market cap simply vanished, right after what looked like a flawless earnings report.
So we've got a glaring contradiction to unpack today. How does a company post record earnings, beat top and bottom line estimates, and then immediately see its stock crash 14%? Like, what on earth did Wall Street see in the fine print that caused such a violent reaction? Why did this happen?
Section 1. The razor and blade engine. To actually solve this paradox, we first need to zoom out for a second and look at exactly how Intuitive makes its money.
You see, their legendary strategy is often called the razor and blade model, and it basically works in 3 steps. First up, the razor. Hospitals buy or lease these massive, incredibly expensive robotic systems, mostly the Da Vinci and Ion platforms. This initial huge capital expenditure essentially locks the hospital right into the Intuitive ecosystem. Step 2, the blades. Every single surgery requires single-use, specialized wrist instruments, drapes, and vision products. And guys, this is where the real money is made. Finally, step 3 is the flywheel. Intuitive secures ongoing maintenance contracts and specialized surgeon training, creating this whole ecosystem that is just incredibly hard to leave. Think of it kind of like trying to cancel a gym membership, but, for a multi-million-dollar hospital wing.
Now, just think about the sheer scale of that flywheel for a second. All those specialized instruments and ongoing services create a sticky, recurring revenue stream that makes up over 70% of their total income. They aren't just selling a robot and walking away. They are monetizing every single procedure performed on that robot, year after year.
And this recurring revenue fuels absolutely flawless fundamentals. Thanks to this model, they've built an unrivaled installed base of over 9,000 active systems globally. That creates extraordinarily high switching costs for hospitals. It also generates these monopoly-like gross margins that consistently float around 65 to 70%, with operating margins that just improved to a crazy efficient 33.6% in Q2. Oh, and on top of all that, they boast a true fortress balance sheet. They added $700 million in cash just during this last quarter, executed $400 million in share buybacks, and carry effectively zero long-term debt. They literally have the billions in cash needed to self-fund their own R&D, totally regardless of the macroeconomic weather.
Which brings us to Section 2, Anatomy of the Crash. If the engine is such a flawless compounding machine, why on earth did the market hit the sell button?
To understand this, we have to contrast the extreme valuation hype going into earnings against the nuanced reality of their forward-looking statements. Going into July, Intuitive was incredibly expensive. It was trading at a forward price-to-earnings ratio north of 50. Now, when a stock is that expensive, investors demand absolute perfection. But reality? Well, it had a few cracks. First, management maintained their full-year procedure growth guidance of 13.5 to 15.5%, but they specifically warned they expect to just hit that 14.5% midpoint. And for a stock price for perfection, aiming for the middle simply isn't good enough. Second, they flagged a slowing rate of growth in the U.S. healthcare market, which is backed up by reports from major health insurers of a macro slowdown in elective surgeries. And third, there's a lingering Class 2 FDA recall on certain Da Vinci components that's heavily weighing on investor sentiment and exposing their concentration risk.
So the crucial takeaway here is that they suffered a severe case of valuation compression. Essentially, this is a rapid decrease in a stock's valuation multiples. When a medical stock behaves like a volatile, high-flying tech stock, any minor guidance turbulence, like aiming for a midpoint or noting macro headwinds, triggers mass profit-taking. The underlying business itself didn't break, right? But the premium investors were willing to pay for it? That certainly did.
All right, moving into Section 3, Strengths, Weaknesses, and Threats. To really judge if this drop is a long-term death spiral or actually a rare buying opportunity, we've got to bring in some character witnesses.
The good news is the company is steered by a deeply technical, incredibly stable leadership team. At the helm, you have Dr. Gary S. Guthart. He's an engineer by trade who joined all the way back in 1996 and has been the CEO since 2010. He's the guy who guided them from a niche hardware play into a true global giant. Backing him up is Jamie Semuth, the CFO, who manages that remarkably conservative and highly efficient capital allocation strategy we talked about earlier. And bridging the gap between brilliant engineering and real-world clinical execution is Dr. Miriam Corrett, the Chief Medical Officer. Trust me, this is not a team that gets rattled easily.
Looking ahead, this leadership team does have a really long runway. Their major opportunity is the multi-year rollout of their next-generation platform, the da Vinci 5. Plus, there are massive untapped addressable markets for soft tissue procedures in Asia and Europe. However, they are finally facing some real, maturing competitive threats. Heavyweights like Medtronic with their Hugo system and Johnson & Johnson with their Ottava platform are bringing true alternatives to the market. Couple that with global inflation pushing hospital budget caps, which means hospitals might choose to just squeeze a little more life out of their older systems rather than buying new ones outright. And remember, if they aren't buying the new razor, that ultra-lucrative blade revenue slows down. It definitely makes the competitive landscape a whole lot more complex.
Okay, let's bring it all home. Section 4, the final verdict. With all the fundamental evidence and market context on the table, let's look at the numbers and figure out exactly where the support levels stand right now.
Fundamentally speaking, if we run a standard discounted cash flow model, factoring in a 9% discount rate and a slowing but steady cash flow growth over the next decade, the true intrinsic value of Intuitive Surgical actually sits right around $365 to $385 per share. So at $410 pre-earnings, it was mathematically overvalued, no doubt about it. But technically, that sharp 14% drop completely shattered the short-term moving averages and gapped down perfectly to a 52-week historical support floor at exactly $344.55.
And if we look at market momentum, that sudden plunge pushed the Daily Relative Strength Index, or RSI, deep into oversold territory, dropping below 25. So what does this combination of a major historical support level and an oversold RSI actually tell us? Well, it tells us that the immediate panic selling pressure is highly likely reaching exhaustion. A short-term relief bounce, or at least a consolidation pattern, is very probable here now that the earnings dust is starting to settle.
With the stock now pushed slightly below its conservative intrinsic value into what a lot of folks would call reasonable buy territory, it leaves us with this final thought for your portfolio. Wall Street demanded perfection and basically threw a tantrum when they got excellence instead. So the question is, are you willing to take advantage of market panic to own a fundamentally dominant company at a fair price? Think about it, and as always, let the numbers guide your strategy. Thanks so much for joining me on this explainer, and keep learning.